they'd like it. Welcome to the Futures Edge Show. I'm Jim Muriel. That's Bob Ichino. That is the impossibly good-looking Seth Cogswell of Running Oak Capital. How old are you, Seth, to have that good of hair and stuff? Are you in your 40s or what?
45.
45. Nice. So Bobby and I are a hair older than you. Before we get started, we'd like to thank our sponsors. First off, unfilteredinvestor.com, where Bobby and I and Mike Arnold take the things we talk about here and bring them down into more granular and tradable, actionable thesis. Also, Independence Arc. We always complain about the food sources, big conglomerates taking it over. There is something you can do, and that's to patronize small independent farms. Marco at Independence Arc is the best. Also, American Gold Exchange and Dana Samuelson. I believe we are at the part of the cycle where owning GLD, just paper gold, is not going to be good enough. I am an advocate of owning physical gold. I own physical gold. Yes, you might need some guard dogs and guns, but you're going to be glad you have it if you need it. Seth, how are you?
Good.
Good. Did you win your fantasy football game this week?
Won all three. It helps when you have Jonathan Taylor on all three teams.
Yeah, so I have Jonathan Taylor too. He's such a beast, man. It is awesome. So that is good. It's nice to have it won. Like they played in Berlin, right? So before I barely even woke up and I already had won the week because of his 40 points. But where are you coming to us from?
Minnesota.
Minnesota, nice. So last question, Bobby and I were saying Running Oak sounds like some sort of Indian name or homage to American Indians. Where's the name come from?
Well, I grew up in Asheville, North Carolina, which is in the mountains, and loved it. It's awesome. And then I ended up living in New York City for 15 years just because that's what happens when you build a career there. It gets really hard to get out. And when I was launching the company, I really wanted something that reminded me of where I came from. And when I started looking, every single LLC that I looked at was taken. It was, right. I don't know how many LLCs there are out there, but it's next to impossible to get a name that you want. And so I finally threw a little bit of a tantrum, got the botanist guide to North Carolina, went through every single plant, and Running Oak was on there. And I was like, man, that is a cool name.
It's a cool name.
It's also the same initials. So ROC, same initials as my firstborn. And so I was like, all right, this going with it. And I love it. I love ROC. However, given that I was a trader and kind of managing a small hedge fund, I never really paid attention to other managers. So then, when it was too late and after I launched it, I had a few people who were like, great, that's what the world needed, was some more oak firms. And I was like, well, I didn't know that. So, that was unfortunate, but I love it. It's and it, it has some sentimental meaning.
That's awesome. Bob?
I don't know if you have if you're old enough to know this, but as an Italian now, if I ever start a capital management firm, it's going to be IROC Capital, the Italian retards out cruising car thing. I had two IROCs growing up, Jimmy. You'll be happy to hear that. I had two IROC Z28s.
Did you smash them both like every other of my Dago friends did?
How many? What?
Did you smash them both like every other one of my Italian friends did?
No. The first one, the T-top started leaking. That was a black and gold. So then I got an electric blue with silver. And some people said it meant I'm really only a Chevy. But I stick with the Italian word we can't say anymore, out cruising. Seth, real quick, I wanted to ask you something that's sort of in the news right now. And I know where Jimmy stands. I haven't talked to him about it, but I just did an appearance on a show called Cowguy Close. It's a cable sort of center of the universe network in the Midwest. Jimmy and I both have regular spots on there. And he asked me about the proposition to give $2,000 checks to everyone in America from the tariff revenue. I am vehemently against it. I think Jimmy's probably more against it than me. Where do you come in on that kind of a proposal? There's a get to know you kind of question.
Yeah. I think that the stimulus that was thrown out from COVID, I mean, frankly, you're really pushing a hot button. I mean, if you go back,
I was hoping
pre-2008, pre-2000, first of all, I'll just say it's amazing how quickly people forget what has historically been the case, right? It takes like a year basically for people to just completely forget what has always historically been the case, right? So prior to 2008, if anyone had ever mentioned printing money or quantitative easing, I mean, every single economist would have just dropped dead right then. Now, 2008, I actually agreed with it. I thought we were, I was managing a book through that, and it was stressful, and it looked like the entire system was going to collapse. So I think it was the right move. But then to do it again and then again, and then again, right? We didn't need to. And then you add on in 2018, we did a massive tax cut when we were at which I'm all about paying as little in taxes as possible, first of all. But doing a massive tax cut when we're at the lowest unemployment level in 5 decades is all but guaranteed to create inflation. Then we had COVID, and we had QE4, I believe, and then massive stimulus payments, and some of those were probably needed, right? Like the servers that couldn't make a penny. I was all about supporting them. There's so many people that had a lot of money that made a lot of money, right? Like, and the thing to keep in mind is that was paid for by debt, right? So the government took our money and then they handed it back, either back to us a little bit, or they handed a whole lot to a lot of people that just didn't need it at all. Which brings me back to your question. I don't know. I think that I'm not a libertarian. I'm all about, I believe that governments have a purpose, such as education, fixing the roads. I live in Minnesota. If they don't fix the roads, it'd be a disaster. But I also think that in this regard, taking on debt to hand people money, just, I don't know. It seems absolutely ridiculous. It's just propping up.
CPI is running at 3% at the same time too. Even in normal times, it seems asinine, and it's obvious why Trump did it. And by the way, so to catch you up on this, both Bobby and I voted for Trump. Both Bobby and I are very critical of Trump right now. If the election were tomorrow, I'd still vote for Trump, even though I disagree with about 60% of his policies, including this one. And the only reason he's doing it is because in 2 to 4 weeks, the Supreme Court's going to hand down their decision. And I guess you two both know this, because he wants it to be pressure from the public on them who might like this policy of giving $2,000. It is plain as day, and it's such a political move, and it's irritating. Agreed?
I hate it.
Yeah, good. I hate it too. Let's put that one to bed then. Good. Okay, let's go on to, I heard you talk about in the last show you were on about passive investing. This has been something that is keeping me up at night. The passive investing that's gone on, let's say 20 years sounds about right, and how it is misallocating capital. I still cannot figure out how to insulate myself, when and how it's going to end, and what it's going to look like on the other side. Walk us through what your opinion is on the passive investing, and if it's a problem at all.
I think it's a big problem in a number of ways. One is just on capitalism, right? We're going to talk about making America capitalism again. When I really got in the business and started to kind of develop a broader view, it always, the idea of passive and just handing money to companies simply based on size just seemed like the dumbest way to allocate capital. Now, then people that argue, well, the market's efficient. Is it? Like, is anybody actually arguing that the market's efficient these days? Many people are saying the market's broken. So I don't know. That seems invalid. So, what investment would anyone ever make? Let's say a house. Are you going to pay 25% more for a 5,000 square foot house versus a 4,000 square foot house without actually going in there, right? Like, it is the dumbest way to invest as far as I'm concerned, unless you have this faith that the market allocates perfectly. As my view has evolved, I also started to get really concerned about kind of the passive narrative. So whenever I or I think financial advisors speak with someone about investment, there are only two main things that we talk about: return, and maybe the most important one is risk. And passive completely ignores risk. Somehow they have gotten away with completely ignoring probably the most important topic that is going to cause the most angst for people at some point, right? Like, the way they address it is, the market goes up on average. The number of people I've had tell me, well, the market goes up on average. I'm like, well, sure, but what if you're retiring in 3 years and we go through a lost decade? It's idiotic, but yet people have just sort of accepted it, which I actually just thought of this, but this kind of maybe a good comparison is cigarettes. How did it ever happen where, let's say 10% of the world smoked cigarettes, 90% didn't? In the 80s, we would go into a restaurant and it was just a given that even though we didn't smoke, we would walk out of there smelling like an ashtray. Yep. And somehow 10% just accepted it. Or sorry, 90% accepted it for the sake of the 10, I don't know. I'm gonna have to work on that analogy, but it seems similar to me. But to evolve it even further, I had a little bit of an epiphany. It's not overly complex, but if I've been having this passive versus active dialogue for decades, and I'm inherently a perfectionist, so the idea of just throwing money in with zero regard for what you're actually doing and how you're investing bothers me. Not to mention just not thinking, that bothers me as well. And I finally had a little bit of a realization, which is if you break passive into its simplest parts, and let's just look at one stock, right? I often use Apple because everybody's familiar with it. So let's say someone has a MacBook and they love it, right? They've edited a video and they're like, man, my MacBook is amazing. And they turn around and buy, let's say they're fairly wealthy, they buy $1 million worth of Apple stock. So at one point in time, if we believe that markets are efficient, then that means that the price of Apple in the real world, it's operating in the real world, is equal to the price you get in the stock market. Now, the stock market is driven by supply and demand, so that's moving around more. But let's say, in this example, somebody buys an Apple or an iMac and they're like, this is amazing, right? And they buy the stock. They had already bought their iMac, so nothing changes at all fundamentally of the company. It's sitting there. But that demand for stock pushes the price up. Now, because that price is higher, every single person that invests in the S&P invests more in Apple because this person bought an iMac a while ago and decided a few months later that they liked it and bought a little stock, right? Then you take that one step further. The best performing strategies over the last decade, by and large, are momentum strategies, right? So there's a lot of money chasing momentum. So let's say this massive amount of money that's chasing momentum sees Apple. They're like, Apple's flying. I got to get some of that. So now they buy Apple. That pushes up more. Now, anybody that invests at this point is investing even more in Apple because it's more overvalued, right? So it's crazy how every single one of us, probably when we were feeling a little cranky and somebody asked for some investing advice, we said, buy low, sell high. Every single person has probably said that in a jackassy manner because it's true, right? Like that
annoys me to no end, by the way, but go ahead.
Yep.
And now if passive is maybe buy at fair value, but then it's buy more the more overvalued it is, then buy even more the more overvalued it is. You never sell, right? So not only is it not buy low, it's also not sell high. You will hold that position all the way down until maybe the S&P, the committee that runs the S&P, says, well, let's kick it out, right? It's the opposite of buy low, sell high. It's the exact opposite of how every single person would ever say it makes sense to invest. And yet, I think now, maybe 60% of equity assets are in this type of construction. And there's so many different directions we could take this as far as.
No, but I just want to know where you think, like, when's the day of reckoning coming and what does it look like?
A lot of people have given up on a day of reckoning. I listened to, I'm drawing a blank. Green Lights. Oh, David Einhorn.
David Einhorn.
And he has given up on the market ever being efficient again. And that doesn't mean maybe that he doesn't believe it will be, but he's playing it very safely in a different manner. There's a lot of people that are just like, but there's too much money going into passive that it'll never go down, which is akin to another thing that's been bothering me a lot is I keep seeing all these people that say we're in a bubble, like really, very intelligent people who say we're in a bubble, but then they say, but it's not going to pop for 2 years. So it's like, all right, we know this is stupid, but just go ahead and do it. Trust your net worth or your financial well-being.
What if this, let's just say, smart guy, also along with saying exactly that, said, so you have to be nimble, you have to trim and trail, you have to buy puts, and you have to protect yourself. Would that be okay? Because I know a guy very closely who has said that on stage just last weekend. Yes or no?
I think so. Yeah, it all depends on your approach, right? One of the things that I'm trying to kind of get out there as much as possible is just get people to think a little bit more about how they're investing. again, passive's avoidance of the whole risk thing has led to a lot of people just investing with zero regard for the risks. And they're not really thinking about it because we have been told that active is stupid, that thinking is stupid, that you're just going to lose money. So just put the money in the market. And there are good reasons that led to that narrative, right? Like it's not unfounded, but do we really want to entrust our financial well-being that we've worked so hard to save up and we're counting on for retirement for our kids? Do we really just want to throw that in a thing, which first of all we just discussed doesn't actually make sense, and do we want to do it without actually thinking at all? I think it's important to remember that one of my issues with the world today is so many people see the world as black and white, and it's almost all gray, right? Like I did not vote for Donald Trump, but I probably agree with a whole lot. You and I probably agree on a lot, right?
Oh, I bet. Yeah.
Almost everybody, probably 80% of the population's in the middle, right? And so I think with passive, it's important to realize that yes, it brought fees down. Passive has had a very positive impact on the investment management industry. It's brought fees down. The market has gone straight up for the last 15 years due to artificial stimulus, which, by the way, tends to really push momentum. And as we just discussed, passive is a momentum structure. I'm not going to say strategy because there's no strategy. It is a structure that benefits on momentum. And we've seen, 15 years of the highest or the hottest momentum ever. So yeah, it looks good at the moment. But again, if you just take a step back, it doesn't make sense, right? It looks good because
I agree. But when does the music stop, Bobby?
Yeah, so I got a couple of comments and then I have some questions. Some of these may seem like pushback, but they're really not, considering that.
Let's go.
Well, considering that I'm a trader at heart. My average hold time for the investments that I manage for myself, friends, and family is 26 days. So I don't think you could describe active any more actively. One of the comments I have though is like, when you hear, I mean, it must make your skin crawl because it makes mine crawl. When you hear nothing beats buy and hold because it makes 9 to 11% a year, because it's completely devoid of any consideration of risk-adjusted returns.
Yeah.
And some of the things I try to tell people all the time is like, look, it's great that it does that on average. That's a good, just nominal return. But I used to work at a fund of funds. I was on the investment committee. I was a principal of that fund of funds. And my job was emerging managers. And we called emerging managers somebody with 3 years of performance or less. Take the broader concept of that. If somebody put the S&P 500's annual returns in front of me, and I saw that it was, 8% one year, 20% another year, 11% another year, then a 50% drawdown, I would have crumbled that shit up and thrown it away. I'm like, we're not looking at this. Like, the risk-adjusted returns are brutal and the drawdowns are brutal. But to your point about active investing, as much as the average person doesn't have the knowledge to know that passive investing is probably not the way to go, which all three of us agree on that, do you think they have enough of a background to develop trust in someone who's saying, and I'm not saying you're saying this, I want to stress that to everybody watching, Seth is not saying this, to say, not only should you not passively invest, you should look into active investing and you should trust me for that. So how do you deal with that? Because we have you on the show because we know you're somebody to trust.
Yeah, I don't know if I'd say that. I wouldn't say that, but or haven't said it a whole lot.
I just said you hadn't said it.
Yeah,
right?
yeah.
We're not quoting you.
Yeah. One of the things, so I'm actually starting, not competing, I'm actually starting a kind of a mini podcast in that I'm starting this small video series. I want it to be short videos. And the sole purpose is to educate and try to, as you mentioned, many people probably don't have the background to assess their options, right? And so my goal is to just help them develop a little bit of a framework as far as critical thinking to just contemplate it, right? I think if we go back to that construction of passive, it becomes clear if you really think of it as simple as form. Now, that doesn't mean we have an answer. It just becomes clear like what we're working with, right? And again, passive isn't inherently bad. It's a momentum portfolio. It's just a matter of, do you want to play momentum? Do you think the market's going to go straight up for 15 years? If so, do it. Although I'd probably prefer a momentum strategy itself, because that has a sell discipline. But that's for another day. Regardless, for most people, I believe it's important to just begin with the end in mind. That's the beauty of, I have a hard time deciding who I'm talking to at times, right? Am I talking to individuals who work with advisors, which is probably unfortunately a smaller percentage of the population, or am I talking to, less wealthy clients who are doing it themselves? The main thing is, again, begin with the end in mind, right? Like, passive probably is a good solution for those who know the least, because it's diversified, it's whatever. But again, I just want them to know what they're doing, right? Like, S&P 500 at this point is massive. It's not a core portfolio. It's not this
It's not diversified, right?
portfolio. It's not. It is a wildly large cap growth portfolio. It's the most overcrowded trade, arguably, in history. There's a lot of overlap between passive and large cap growth, because the only way for them to keep up with the S&P was to be all in on the same companies. And then if you were to look at most people's portfolios, they probably all own the same companies too, right? So when we talk about how overcrowded the S&P or passive is, it doesn't even do it justice how overcrowded it is. And we all know what happens when a crowd or a mob tries to rush out of a burning building, right? And a burning building is inevitable. That's what happens in the stock market, in the economy. Yes, we've had firefighters just sitting there dousing everything with water before there was even a hint of flames, but that's not going to last, right? You only have so much water. At some point, people are going to realize how they're positioned. It might just be seeing their account decline. And my goal is to really get people to think about the other options, right? Like, just, there are other, even if you want to stick sort of within passive, there's factor-based portfolios that can provide you just some diversification, right? So there's a lot of different options. I worry a lot that people don't have the slightest clue how much risk they're taking right now, right? I mean,
I actually, so to just as a follow-up, I think that's fact. I think it's a fact that people have no idea how much risk they're taking. They have no idea how they're exposed to momentum. And historically, small cap outperforms large cap, except like the last 15 years, right? Where all of a sudden large cap and momentum is outperforming everything, and small cap's having a hard time catching up. So to that point, tell me if you would add something to this, if you think this is stupid or what. I say to people all the time that outperformance to the downside is what you need to pay attention to. If you can find somebody that performs and then outperforms to the downside, what I mean by that, 50% drop in the S&P, 60% drop in the NASDAQ, the person you're entrusting with your money is down 18.
Yep.
That to me is a better way of looking at it. Would you add anything to that? You said yep, so I'm assuming you agree with that perspective.
Yeah, no, I mean, I definitely agree with that. I mean, it's kind of two sides of the same coin, right? The goal for all of us, again, going back to beginning with the end in mind, what is our goal? Our goal is at a certain point, and the problem is everybody has different points, right? So throwing everybody, that's another issue with passive, is it treats everybody the same when we're not. We're all different. We're all at different stages of our life, right? So begin with the end in mind, first of all. If, let's say 20 years from now, if your goal is to be able to retire, then what you're looking for is cumulative growth over that time. There's two big drivers of cumulative growth. One is return, but also if you really factor in risk and volatility, the obvious example is you drop 50%, you have to double your money to get back to even.
Right.
It's really hard to double your money.
It's really hard to do that.
Whereas if you make a few tweaks on the margin, maybe you're down 30%. And nobody's going to be like, yes, I'm only down 30%, but it only takes you a 40% return versus 100 to be making new highs. Not only that, the other thing that the passive narrative drives me crazy on is it completely overlooks, our behavioral patterns, right? So if someone, the way they deal with this is they say invest, average down, never sell. Fine. That's not necessarily a horrible, it's not horrible advice, but it's very well documented that investors, including myself, I've done before, when you experience a huge drawdown, it sucks. It's really stressful. You're not sleeping, right? You're watching your future. You're watching everything that you've squirreled away kind of disappearing. And that leads people to make poor decisions because they're stressed. And so to push people to be in these portfolios that are wildly volatile, we just haven't seen the volatility in the last 15 years because of artificial stimulus, but to push people to take that risk and to assume that they're not going to sell when they see their net worth decline significantly is just, it's not accurate. It's not realistic. So I think you're absolutely right. I think that's focusing on risk is a critical part. The other thing is, first of all, is how much money do you need, right? Like, let's say that you've got more than enough return, which I would argue over the last few years, we've been way above average. Great. If we're in a casino and we get a hot hand, we're probably going to we know that we could lose that and we're going to put some of it away. People aren't doing that. If anything, they're piling in more. And the issue is, how much do you need to make? Because what I can guarantee you won't like is if it drops 50% and you're all in.
So I'm sort of muzzling Jimmy, which is very difficult to do because unfortunately I have to
never really been done.
It's never really been done. It's because
he sent me a text saying, "Shut up, I got another question."
Yeah, I'm the reason that we had to move this recording an hour earlier because I have a commitment that I can't shake. But I wanted to sort of not necessarily change the subject, but ask you about something. This past week on Thursday, I was on a panel at the Naples, Florida Wealth Symposium, and they put me on a panel that they called Bitcoin inclusive, but not Bitcoin focused, which was a good thing because a Bitcoin focused panel with me, I was going to get stuff thrown at me. Not because I think Bitcoin is complete rubbish, but I think really the people who buy and hold and never sell are complete rubbish. I think those people are rubbish. This particular group of people has a meetup at Steak and Shake, if you guys are familiar with it. And they go there because I love Steak and Shake, dude. They go there because Steak and Shake accepts Bitcoin, yet none of them will spend Bitcoin on Steak and Shake because they don't want to sell one nub of Bitcoin, not even get what would be a free burger for most of them because they bought it so long ago. And they asked me what my thought on Bitcoin was, and it was twofold. I said, number one, who in the room here only invests in Bitcoin? And probably about 60, 70% of the room raised their hand. I said, you guys are one of the reasons why I'm sort of anti-Bitcoin right now, because you think nothing else is worth your investments. Number two, none of you look at Bitcoin on a risk-adjusted basis. None of you. You do the thing that real estate agents do. Real estate agents, it's a good time to buy or a good time to sell, no matter what the market is doing. And those people drive me crazy. I cannot wait till AI eliminates those people. I'm sorry if either one of you is close to a real estate agent. Number two, what do you think of, or the question, I'm sorry, what do you think of Bitcoin? And what do you think of the things I just said about it? Is that a reasonable reason to not like it? Which is where I'm at right now. That smirk makes me so happy. Go ahead.
I usually avoid this question. Maybe we
can't
should
avoid it here. We're in a bar.
We should have reviewed questions before.
You got a guacamole shirt on. You have to
answer the question. Yes. If you were to look at the definition of a Ponzi scheme,
I like where this is going right away, Seth.
Bitcoin fits the definition of a Ponzi scheme to a T. Like it's absolutely perfect. Now, that said, again, we're in the gray. If enough people adopt it, then maybe there's a chance it becomes legitimate. But one of the things, I got a bunch of friends. I have this discussion with friends all the time, but again, I don't do it publicly.
Doing it now.
Bitcoin, so at least people now, for the most part, seem to agree that Bitcoin is not an asset. It is not an asset. It's not backed by a cash flow of any kind whatsoever. It's also not technically a currency. It's not backed by a government and like a military and the ability to tax and whatever else, right? As much as I hate what the U.S. is doing at the moment and killing the value of the dollar, there's still value. The key word is value. There is a value to the dollar. Now, what people don't, if something comes out tonight, let's say there's some sort of epiphany and people are like, Bitcoin's not real, right? And it becomes clear. There's no arguing it. Tomorrow, Bitcoin is worth zero. It's worth zero because nobody's going to buy it. It's nothing more than an electron. As long as people are willing to pay for it, fine, right? Like, I kind of look at it as like a Beanie Baby, right? Like people are willing to pay crazy prices for Beanie Babies, but you got a Beanie Baby, they're kind of cute. Bitcoin, you can't even really look at, I guess, other than like the dollar amount. Yeah. So that's how I look at it. Again, I try to be agnostic because I don't know. I would say I've been wrong more than almost anyone, but also I've been right, around the same amount. So I've also been right a lot. But so the key is that I know that I'm wrong on a regular basis. And so I reserve the right to be humble and know that, maybe I'm wrong.
I don't mind what you're saying, by the way, but when you said about adoption and its root structure going down, that's the only reason I started buying it, is because it seemed like the root structure was not unshakable, but it was becoming more and more stable. I didn't mean to cut you off. Please continue.
No, I agree. That's why, I was maybe more on the Ponzi scheme camp early on. And now I'm just like, we'll see, right? Because of that root structure. However, Mike Green, who's at Simplify.
We know Mike. Yeah.
I know Mike. Yeah.
Mike did a podcast with Brandon Ducharme.
I saw that.
And it was awesome. I loved it because instead of looking at it from the beginning of Bitcoin to today, which is how I've always looked at it, he looked at it from today into the future and tried to play it out. And if you listen to his, I won't do it justice. I need to listen to it again to actually do it justice, but it was awesome because it was a totally different perspective. And it basically explains why it can never be a currency. Anything with a limited quantity can never be a currency. That's another thing that also bothers me. Am I allowed to curse on here?
Yeah. Hell yeah.
Yeah.
All right, let's go.
Shit, yeah.
The whole scarcity narrative kills me. Scarcity does not guarantee value, right? maybe I should have brought him down here. I have the greatest beagle ever. All right. All 4 of his grandparents were grand champions. His mom and dad were grand champions. His sister won Beagle of the country. He only cost like $1,500, so a whole lot less than the fancy poodle ones. But regardless, he's awesome. I mean, he's about as cool of a beagle as you get. He only takes probably 2 shits a day. So if you extrapolate that, I don't know. I mean, we're looking at a pretty finite number of shits, quite a bit fewer than Bitcoin. Nobody's lining up to give me like $100,000 for my dog's shit, and which kind of bothers me because
Thank God you tied that one up. I was like, okay, where are we going? Buckle up, but I liked it.
Well, the last thing I'd like to throw a question to both of you, and then after I hear your answers, I'll probably sign off. Jimmy, I mentioned this once before. If we're talking, the reason I don't like to call Bitcoin a Ponzi scheme is because of what you said, Seth, where if enough people adopt it. But the Bitcoin community doesn't seem to be focused on adoption to me. I said this on a Bitcoiner invited me on their podcast. And I said, anytime I ask a question, Bitcoin people just call me a boomer and hang up. And I'm like, you guys are assholes, kind of, So like, why don't you help me learn? So maybe I adopt it. But Jimmy, I want you to answer this first so that I'll actually let you talk because I feel like I'm being a jerk. If we look at something that is only valuable as more people buy it, it's also momentum stocks in a way because they're not necessarily producing more. And we're comfortable calling that a bubble. But the crypto people are not comfortable recognizing the bubble-like characteristics. I hesitate to call it a Ponzi, but I get what you're saying, Seth. I agree. But everything, basically the value of everything is based on people starting to buy it more rapidly, as you so aptly described. So Jimmy, am I crazy in thinking that there's a lot of things that are similar to Ponzi schemes out here right now?
Well, you said everything and not everything, food and water and land.
Of
No, I mean,
course.
that's, that there are things that are different. But yes, the Honus Wagner baseball card, a Picasso that hangs on a wall. These are things that we all just agree have a certain value to it. So there is something, and like Seth even mentioned Beanie Babies, and even when Beanie Babies collapsed after the fervor, there are still some value to them. People still trade, I think. I'm not sure of that, but it didn't fall completely out. So the question is, what is Bitcoin? Again, I've said a million times that I think it's a risk parity trade sort of for me. I believe that in 10 years, Bitcoin's either going to be $1 million or it's going to be zero. I think it's more likely going to be zero or thereabouts. But to get it for me to, I don't want to be wrong and be broke while they were right. And because if they, again, you have me at lack of faith in stewardship of fiat currencies, which is that lack of faith has been earned. So do I have it as a standalone? No, I have it in my stupid dollar policy portfolio, which is gold, silver, Bitcoin, real estate, shit like that. Seth, you go.
I mean, I feel like Bernie Madoff wouldn't be known as one of the greatest Ponzi schemes ever if the market hadn't declined, right? Like that was very clearly a Ponzi scheme, and it could have continued. Like if more and more people embrace it, and more people kept pumping money in, then he could keep this shell game going forever, right?
Yeah.
I don't know that's that different. So there was somewhere else I wanted to go with this.
No, but I see. Okay, so Seth, I will push back because I do think it's different because Bernie Madoff was definitely based on a lie. He was saying that things existed that did not. Bitcoin is
sounds
nothing.
like Bitcoin to me, Jimmy.
Okay, forget it. Okay, he'll take it. Let's pivot because I want to know. Like, I want to describe someone to.
I'm gonna jump, guys. Thank you, Seth.
See you, Bobby. Good to see you.
Bobby, good seeing you. Thank you.
Seth, here's my question to you, because we don't like passive, and I agree with it. And by the way, I do have some SPY and I have some QQQ. It's a hedged position. I do believe we're in the early stages of a bubble. But let's say you have someone who's got a 10-year time horizon to their retirement. They have a portfolio that's, a buck or a buck and a half, decent, but not fantastic. How do you structure a portfolio that you think is the right thing to do for the next 10 years?
Well, I mean, first of all, I'm biased. We manage a portfolio that, to me, makes perfect sense. It's also
it may make perfect sense to me too. I'm not against it at all. But go.
I try to always. I feel like there's a serious lack of common sense going on in the world today, and so I try to make that my starting point at all times. The other thing that I've actually thought about recently is, I don't have a FOMO bone in my body. I have no FOMO. Like, there's no keeping up with the Joneses. I am completely comfortable with everybody doing whatever they're doing, and I don't feel left out. And so, your comment on Bitcoin, like whether it's a 0 or $1 million, if it ends up being $1 million, you want to be a part of that. Whereas I'm like, well, it doesn't make sense to me, so I'm just not going to do it.
No, but if it goes $1 million, I don't want to be part of it because of the Bitcoin and making the money. I want to be part of it because of the implication that has for the dollar and other dollar denominated assets, just to make that clear. But you go.
No, that makes sense.
Yeah.
That makes sense. One of the realizations I've had, or I've been kind of dealing with, is the last 6 months in the stock market has maybe been the dumbest period in the history of the stock market. And so few people are aware of it. It kills me. So there's a number of different ways you can measure this. But first of all, Bloomberg breaks factors, the market down into 223 factors. The high volatility, which is swinging all over the place, usually the riskiest of companies, are up 100% in the last 6 months. Best move, it's either the best move or the second best move ever since that data goes back. We know that destroys value. We just talked about big drawdowns and the fact that you don't want to be in that. Low volatility, on the other hand, which has been proven to, there's a lot of data supporting that it adds value, is the 223rd out of 223 factors over the last 6 months. So we know that adds value, and yet it's by far the worst performing. Another worst performing is quality, right? So there's different definitions, but companies that are profitable, that have reasonable amounts of debt, whatever, right? they're well-run companies. That has been one of the very worst performing. Profitability, so companies that make money, that has been one of the very worst performing. While on the flip side, again, you got high volatility, meme stocks. So if you define that as volume over float, so it's basically stocks are trading a ton. Every day I go on, it seems like 5 stocks are up 200% on the day. It's nuts. And then the other one was momentum. Regardless, the whole point of that is the last 6 months have been nuts. And so that has led, our strategy is built on common sense, right? We invest in companies that make money because we feel that in the long run, it's, if you're going to invest in something, it's good to make money. We invest in, by default, kind of high quality companies because we are focused on debt. We don't want to invest in companies that should go bankrupt. That seems like a sound idea. And then low volatility has been
defensible.
And then low volatility has been proven to provide value. We know that for our clients, we want to provide lower drawdowns because it means that they can sleep better at night and they can, hopefully higher likelihood of making it to their goals, whatever those are, right?
Yeah.
So what we invest in has been some of the very worst performing. What we intentionally stay as far away from has been some of the best performing. Because of that, it's been an interesting 6 months for me in that when I speak with a lot of our clients, most of them are like, you're doing great. And I'm watching the S&P and whatever else. I'm like, I don't know where you're getting that from, but I love it. I appreciate you saying that. But then there's another firm that I've been helping more deal with what's going on because they did not take into account FOMO. They have our portfolio as a big part of their portfolio. They have another one that is a little more growthy and it was supposed to kind of provide that. But regardless, there's some pretty serious backlash at the moment because they didn't cater to the FOMO. And that was a risk.
Yeah.
And so all that said, if I'm building a portfolio and I'm left to my own devices, our strategy, first of all, our strategy is the only one I own right now. It's the only equity portfolio. That said, there's some really cool ones that are very different. So I'm sure, once my company grows to a certain size and I actually have a savings account again, then I will invest more in like really cool differentiated strategies. But if I'm left to my own devices, I probably would have had little to no Mag 7 for the last 6 years because according to our numbers, it just didn't make sense. Now it's played out, it's worked out. So if you're really going to build a portfolio, if I'm going to do it for an individual, and the key is for them to stay the course, I would do something like our strategy, which kind of sits in the middle. It's very risk focused. It's designed to maximize earnings growth and invest in companies that are making more and more money. But then I'd complement it, because of what we're going through right now, with either a slice of the Qs or a slice of probably a large cap growth momentum strategy. That's actually what I'd lean toward. And then value, dividend. There's some interesting things in that space as well. And then I think it's Bobby that touched on small cap. I think small cap is where you can get outsized returns because there's companies that nobody knows. But small cap as a broader investment right now, I think is horrible. I'd probably stay pretty far away from certainly a passive or a really diversified portfolio in small cap because that's where all the zombies live right now. And there's a lot of zombies. We got a zombie apocalypse coming on right now. And so I'd avoid that. Small cap and value will do really well when we're coming out of a recession. I believe that they're going to get absolutely smoked going into recession because there's so much dead weight in there.
So what I think is that, because I've thought long and hard about the things you're saying about what is, risk mitigation. So do you think that your Philip Morris and your utility and your ConocoPhillips, are they not going to get hammered at the same time everybody rushes out of the Mag 7 if the Mag 7 are getting so overvalued? And if we're of the belief that there's some level of bubble and that bubble pops, is there going to be a place to hide in those stocks? Or is it what Bobby said, is just instead of losing 50%, you're going to lose 20% and you're going to dodge the bullet? Which is it going to be?
So in a lot of ways, today reminds me of the tech bubble in a lot of ways. In the tech bubble, you saw a lot of money go into a handful of companies, more than a handful, but into companies. Those companies, as passive is a momentum structure, they became a larger and larger percentage of passive, which drove passive up with these stocks. But in 2090, let's say 99 or so, a lot of companies didn't participate. A lot of stocks just sat there. In fact, a lot were negative, which we're actually kind of seeing right now. And so that meant that when the market came off in 2000, 2001, value, small cap, high quality, our portfolio, although performance isn't audited, but it was run then. But regardless, plenty of things were actually up. And so I think about that a lot. Now, that said, if we are in something that's similar, I don't expect those areas to be positive like it was in 2000, because the investing universe has evolved into more like basket investing, right? Like not many people are buying and selling stocks. It's more buying ETFs or mutual funds or index funds or whatever, right? And so things get grouped in. Now, the issue is, though, one, we have seen that diversion or that dispersion come in recently, where I'm going to mess this up, but I mean, I think like 30% of stocks are at 52-week lows while the stock market's going straight up.
Yeah.
And so right now there are a small number of companies that are flying, largely anything that's related to AI. And where we really invest is in this upper, mid, lower, large cap space that, from what I've seen, people own almost none of, right? So if we say that the large cap, the Mag 7, is arguably the most crowded trade in history, maybe,
sure,
we're not in that. And because of that momentum aspect of it, the stuff that we invest in, the area we invest in, have become smaller and smaller percentages of the index. So if people sell the index, let's say the SP goes down, they're technically selling everything, but they're going to be selling a whole lot of a small number of things. And then there's a whole lot that, again, is barely participated, tiny percentage. Yeah. And so it takes very little active investment to come in and potentially overwhelm that, which could lead to positive returns when the market's down.
Or if you're taking a punch, you're taking a much more of a glancing blow than taking it straight onto the face. That's what you're saying too, right? You could see a scenario where you lose money, but just not that much.
Definitely. Yeah. And when we say lose money, that means be down, right? But like, if your time frame's whatever, again, we talked about how hard it is to make that money back. So if your time frame is a little ways out and you're down a lot less, fine. One thing that I focus on a lot that people just, again, going back to the buy low, sell high, there is this whole, like, the idea of valuations and actually thinking of value in almost every aspect of life. If we go to a store and we see strawberries for $12 and they're usually $5, I'm not buying them. I think most people, that's the case, right?
Yeah.
But somehow in the stock market, valuations and, like, just what an asset.
We buy 2 buckets of strawberries.
It's gone out the window. It's like, oh, strawberries are $12. I'm going to buy all of them
before they get to be 20, right?
And like, how much sense does that make? And so, Apple is a good example that I use, where Apple's PE right now is 38, 39 or so. Historically, its average PE was like 14 to 15.
Right.
So Apple could drop 50% tonight, and it wouldn't be a big deal. 50% sounds like a lot. Imagine seeing your net worth drop 50%. That's not a big deal. Apple would still be overvalued relative to its long-term, quite a bit overvalued relative to its long-term valuation. Yeah. And so it's risk, right? It's just, think about what could go wrong, right? Like, everybody's in this FOMO trade. We've been taught to just buy anytime market even remotely goes down, and we're guaranteed to make money. That is not the way the stock market works in the long term.
No, I love a lot of things you're saying. I think you and I are simpatico on a lot of that. The way we look at risk. Again, fear of missing out is an awful thing. And that, I want to underscore again, that's not what I meant about the Bitcoin trade. I just don't want the dollar to go to zero. Can you tell the people where to find you? And by the way, can you promise to email me something about is it a fund, or is it an ETF, or is it both?
It's an ETF. Well, we offer it in 2 ways. We offer it in what's called a separately managed account. So we set up an account for a client and we invest it for them. Otherwise, the ETF is probably the best.
Can you say the ticker or no?
I'm not going to right now, just because.
Don't say the ticker. Yeah.
Otherwise, I can't share it. But
right.
Definitely look me up. You asked where you can find us. runningoak.com, runningoaketfs.com if you want to actually, specifically look at the ETF, which I favor.
The Voldemort ETF that we were not mentioning. Right. Okay.
Oh, that's really funny that you're, I love that. And then hit me up on LinkedIn. I'm doing a lot more. I used to run screaming from videos and interviews, and in the last year, I decided it was time to stop being a weenie, and I've
Right.
embraced
It's
it.
time to get in front of a camera. Well,
So
thank you so much for this. Has been a great conversation and really illuminating for me too, because I'm very interested in the ETF and the style of trading. I want to thank you guys watching. The live shows are my favorite, because all the audience participation. Thanks for the running stream on Twitter of comments. You guys are the best. Thank you to our sponsors: Independence Arc Farms, Marco, grass-fed, grass-finished beef, unfilteredinvestor.com. The win rate for Bobby and Mike so far is amazing. We're talking about being a nimble investor right now in somewhat precarious times. Take a look. Also, American Gold Exchange. The I think what you call it is the link will be on our page. You can find it if you want to buy physical gold and silver. Please do. Thank you, guys. I'm Jim Uriel. This is the Future's Edge. That's Seth Cogswell, and Bobby Iacchino. Thank God is gone because he wouldn't shut up.
he was bringing